I have watched hundreds of hours of anime set in Japan. Dragon Ball, Naruto, Re:Zero, Your Name. I genuinely love Japanese culture. The discipline, the precision, the way that country operates differently from anywhere else on Earth. There are places in Japan I want to visit one day, places I first saw through an anime screen as a kid. The Suga Shrine Stairs in Tokyo, Japan, that appear in Your Name, that is one of them. But there is one Japan story I was never told growing up. And once I understood it completely, it changed how I see almost every economy on Earth. Not just Japan's. So before anything else, one number. December 29th, 1989. Japan's stock market index, the Nikkei 225, closes at 38,915 points. At that exact moment, credible economists from major research institutions are projecting that Japan will surpass the United States as the world's largest economy within 20 years. At the same time, Japan's land, the physical territory of a country roughly the geographic size of the US state of California, is estimated by widely reported contemporaneous valuations to be worth approximately 4 times the total value of all US land. A country the size of California, 4 times the value of a country roughly 25 times its physical size. And within 5 years, it was over. Japan's Nikkei would not close above its December 1989 high for another 34 years. 34 years to return to where it started. So, here is the question. How does one of the most disciplined, most innovative, most productive industrial societies in history spend 34 years trying to recover from a single decade of excess? That question has a specific, traceable, fully documented answer, and that answer teaches you more about how economies actually work, about debt, about central banks, about the relationship between policy decisions and long-term consequences, in almost any other case study in modern economic history. That is what this video is. 30 years of Japan's economic story, from the post-war miracle to the bubble to the collapse to the recovery attempt to what is actually unfolding right now in 2026, told in full, in sequence, with nothing skipped. By the time you reach the end of this, you will understand 3 specific things that most people around you, including people who follow financial news regularly, cannot explain clearly. And before we go anywhere else, one brief note. Everything in this video is purely educational. This is documented economic history and structural analysis, not investment advice, and I am not a financial advisor. Now, why Japan? And why right now? If you live in India, or the United States, or Europe, or almost anywhere in the world, why should you spend significant time specifically on Japan's economic story? Here is the honest answer. The specific combination of forces that shaped Japan's trajectory over 30 years, rising government debt relative to GDP, an aging population, an extended period of near zero interest rates, and then a central bank attempting to normalize from those rates, that exact combination is now present across most of the world's major economies. At different stages, at different intensities, but the same forces, moving in the same direction. The United States Federal Reserve held interest rates near zero from approximately 2008 to 2015, and again from approximately 2020 to 2022. And the US debt to GDP ratio has since crossed approximately 125%. The European Central Bank ran negative interest rates for years, a policy Japan invented as it turns out, while several European economies carry debt to GDP ratios above 100%. China's combined public, corporate, and household debt has expanded significantly relative to its total economic output over roughly 2 decades. Japan got there first. Japan has been living the consequences and searching for the exit for 30 years. Understanding Japan is understanding what the data looks like when these forces reach their full effect. And here is where it gets genuinely interesting. Japan's central bank, the Bank of Japan, raised its official policy rate to 1% on June 16, 2026, the highest level since approximately 1995. That single policy action, from a country's policymakers most people stopped actively thinking about decades ago, triggered visible movements in global equity markets, bond markets, and currency markets within days of the announcement. Japan is not history. Japan is a live, ongoing experiment, and we are about to understand exactly why that is, starting from the very beginning. But before we go back in time, I want to tell you about something I built specifically for people who find this kind of analysis genuinely fascinating. I have created a complete course titled Applied Macroeconomics. It covers everything this video explores, and significantly more, built as a structured, curriculum-driven deep dive into how the global economic system actually functions at every level. Total course video content over 2 hours, and I intentionally stripped everything that was not directly valuable, so every minute of it is dense and purposeful. You also get email support, so if anything in the course raises a question, you can get it clarified. For those who want the course, the link is in the description below. And for those who want to start somewhere more accessible, there are books in the description as well, and I've included the 3 I consider most directly relevant to everything we are about to cover. Now, back to Japan, and we are going back much further than 1989. 1945. Japan's major cities are in ruins. Tokyo, Osaka, and Nagoya, the industrial centers of Japan's pre-war economy, have sustained severe damage from aerial bombardment across the final years of World War II. Hiroshima and Nagasaki are in a separate category of destruction entirely. Japan's industrial capacity is gone. The country is under foreign military occupation for the first time in its recorded history. And from this condition, Japan builds the world's second largest economy within a single generation. Almost no major economy in modern history has accomplished anything quite like it, reaching the world's second largest economic output from near complete destruction in a single generation. How? 3 specific things, operating simultaneously. First, the deliberate industrial strategy. Japan imports approximately 85 to 90% of its oil from foreign sources, transported through shipping lanes in the Middle East. And if you want to understand exactly what that dependency means for how Japan behaves geopolitically and economically, I covered that choke point in detail in an earlier video on this channel. With that structural vulnerability understood, Japan's response to its scarcity of critical industrial raw materials was to pioneer world-class efficiency standards, like lean, and build a globally dominant, high-complexity manufacturing ecosystem designed to maximize the utility of every imported material. Japan's Ministry of International Trade and Industry, known as MITI, functions as a national investment director during Japan's Reconstruction era. It identifies which industrial sectors Japan should develop, in what sequence, and with what level of government coordination and targeted subsidy. Steel first, shipbuilding, electronics, then automobiles. Each sector is developed sequentially, not because all sectors receive equal resources simultaneously, but because Japan deliberately concentrates limited capital on the highest leverage sectors in order. This is the opposite of what many developing economies attempt. The approach concentrates capital rather than spreading it thinly. Second, the quality revolution. In the early 1950s, Japan invites an American quality management researcher named W. Edwards Deming to lecture at Japanese industrial associations. Deming's core insight that quality should be built into the manufacturing process itself, rather than inspected for after production, is, at this point, largely being ignored in the United States, where Deming worked. Japan adopts his framework with systematic, disciplined implementation across its manufacturing sector. The result, within roughly 20 years, Made in Japan transforms from a label associated with inexpensive imitation products into a mark that signals precision engineering and reliability. Japan's automakers and electronics manufacturers are not winning on price alone by the 1970s. They're winning on verified quality and reliability, and the competitive gap keeps widening. Third, the corporate structure. Japan's major companies are organized into networks called Keiretsu, interlocking groups of companies that hold each other's shares, use each other's services, and are backed by affiliated banks. Toyota does not simply purchase components from independent suppliers at the lowest available market price. Toyota maintains long-term relationships with supplier companies that are themselves part of the Toyota network, sharing design information, quality standards, and production coordination. This structure provides a specific competitive advantage: long-term capital allocation without short-term shareholder pressure. No quarterly earnings target is forcing Japan's industrial companies to cut R&D investment or supplier relationships. They can plan in decades. The combined result of these three elements, over approximately 25 years, Japan's GDP grows at an average rate of approximately 10% per year from roughly 1955 to 1970, one of the fastest sustained growth rates any large economy has ever achieved in the modern era. Japan becomes the world's second largest economy, behind only the United States, by approximately 1968. By 1985, Japan's annual trade surplus with the United States reaches approximately $40 to $50 billion. Japanese automakers, Toyota, Honda, Nissan, are capturing significant U.S. domestic market share from American manufacturers. Sony, Panasonic, and Toshiba simultaneously dominate multiple categories of global consumer electronics. And here is the data point that makes this era essential context for everything that follows. By 1985, mainstream economic projections from credible institutions suggested that Japan could surpass the United States as the world's largest economy within roughly 20 years. This is not fringe analysis. This is the consensus expectation about a country that had almost no functioning economy 40 years earlier. Now, here is the specific tension that was building by 1985 on the other side of the Pacific. The United States, in the early 1980s, is experiencing significant distress in its domestic manufacturing sector. American automakers are losing domestic market share to Japanese competitors, primarily because Japanese manufacturers are producing more fuel-efficient, more reliable vehicles at comparable price points. American electronics manufacturers are facing the same competitive pressure across multiple product categories. U.S. unemployment in the early 1980s peaks at approximately 10.8%, the highest level since the Great Depression of the 1930s. The political pressure in the United States to address the trade imbalance with Japan is real, publicly documented, and growing through the mid-1980s, including tariff proposals and voluntary export restriction agreements on Japanese automobiles. If you want the full mechanics of how trade restrictions work as economic and political tools, I covered that in detail in an earlier video on this channel. This tension sets the stage for September 22, 1985. What happens on that date, at a hotel in New York City, sets in motion a specific, traceable chain of events that ends in 34 years of economic stagnation. But before we get into the bubble and how it formed, later in this video, we are going to cover something that almost no other analysis of Japan's story includes. We are going to map exactly what is happening in Japan right now in 2026 and connect it directly, step by step, to everything that started in 1985. Japan's story did not end in 1990. It is actively unfolding, and what happens next has direct implications for asset markets in every country on Earth. Keep that in mind. We are building to it. September 22nd, 1985. The Plaza Hotel, New York City. The finance ministers and central bank governors of 5 nations, the United States, the United Kingdom, France, West Germany, and Japan, convene for a meeting that is not publicly announced until after it concludes. The agreement they reach is called the Plaza Accord. The stated objective: coordinate intervention in international currency markets to depreciate the US dollar relative to the Japanese yen and the West German Deutschmark. The official rationale: the dollar had appreciated significantly since 1980, making US exports expensive on global markets and contributing to a large US current account deficit, and correcting these imbalances is framed as a shared objective among the 5 nations. Here is what the verified data shows happened in the years that followed. At the time of the Plaza Accord, the exchange rate is approximately 240 Japanese yen for every 1 US dollar. Within approximately 2 years, coordinated currency market intervention and shifting capital flows move that rate to approximately 150 yen per dollar. Within approximately 3 years, it reaches approximately 120 yen per dollar. The yen has roughly doubled in value against the dollar in approximately 3 years. In practical terms, every product Japan sells to the United States, every automobile, every consumer electronic, every piece of industrial equipment becomes approximately twice as expensive in dollar terms within 3 years. Japan's export-based economic system, the engine of its entire post-war growth model, is suddenly facing a severe cost disadvantage in its most important foreign market. Japan has a specific word for this, endaka, which means high yen. And I want to be honest about what the academic record shows on causation here, because this matters for how we understand what came next. Some economists argue that the Plaza Accord is the primary cause of Japan's bubble. Others, including researchers at institutions like Harvard University and the National Bureau of Economic Research, argue the causation is more nuanced. The most extreme bubble years of 1987 to 1989 occurred after the exchange rate had largely stabilized, suggesting Japan's own domestic monetary policy decisions in that period carried at least comparable weight. What the verified record clearly establishes is this: the Plaza Accord triggered Japan's emergency rate cuts. Those cuts, maintained longer than the domestic situation likely required, created the conditions for what followed. And I want to be precise. This is not an argument that the United States acted unreasonably. US domestic manufacturing was under genuine documented competitive pressure in 1985. The policy response to that pressure is what the verified data records. What the data also records is the chain of consequences that followed. What followed was the largest asset price bubble in recorded economic history. Here is the specific mechanism, and this is the part that almost no mainstream coverage of Japan's bubble covers precisely. Japan's central bank had a system called window guidance. Under window guidance, the Bank of Japan met with major commercial banks each quarter and told them, effectively, how much total new credit they were permitted to extend. During Japan's post-war industrial era, this system had directed credit toward productive manufacturing sectors, coordinated capital allocation that powered the miracle. In the low-rate environment of 1986 to 1989, with the official discount rate cut 5 times from approximately 5% to 2.5%, the lowest since World War II, and with credit flowing at guidance-directed volumes, the question is where that credit went. Not primarily into new industrial investment, into real estate and equities. Land prices in Tokyo, Japan's 6 major commercial districts, increased by an estimated 125% between 1985 and 1988. The Nikkei 225 moves from approximately 12,000 in 1985 to 38,915 by December 29, 1989, an increase of approximately 225% in 4 years. And the self-reinforcing mechanism that keeps this going is worth understanding precisely. Rising real estate prices improve the value of the collateral that Japanese banks and companies hold on their balance sheets. Improved collateral values enable more borrowing against those assets. More borrowing enables more asset purchases. More asset purchases push prices higher, which improves collateral values further. Each individual step in this loop is rational for the participant inside it. The loop as a whole cannot continue indefinitely. One additional factor amplified this at scale. The Keiretsu structure, Japan's interlocking corporate shareholding networks, means that when one company's stock price rises, All companies in its affiliated network show improved balance sheet valuations simultaneously. This enables more borrowing across the entire network, which enables more asset purchases across the entire network, which pushes prices higher across the entire network. The corporate structure that had been an industrial strength in peacetime becomes a financial amplification mechanism during the bubble. And here is the data on what the valuations looked like at the peak. Price-to-earnings ratios on Japanese stocks reach approximately 60 times earnings at the peak of the bubble, at a point where long-run equity valuations are historically in the range of roughly 15 to 25 times earnings. At 60 times earnings, a stock implies a return of less than 2% per year before any growth assumption. When the underlying growth expectation corrects, the mathematics of that valuation becomes very difficult to sustain. In September 1989, Mitsubishi Estate, a major Japanese real estate company, purchases New York's Rockefeller Center for approximately $846 million. This transaction becomes one of the most visible symbols of Japanese corporate ambition at the bubble's peak. Golf club memberships in Japan, at the peak, trade for the equivalent of hundreds of thousands of US dollars and are accepted as collateral for bank loans. The Bank of Japan's own economists flag the valuation levels internally. The warnings are on record. Between May 1989 and August 1990, the Bank of Japan raises its official discount rate 5 times, from 2.5% to 6.0%. The rationale is legitimate and well understood. Land prices are visibly unsustainable, inflation indicators are rising, and monetary tightening is warranted. The bubble does not slowly deflate. It collapses. The Nikkei 225 falls approximately 38% in the calendar year 1990 alone. Tokyo, Japan's commercial real estate values begin declining and will continue declining for approximately 15 consecutive years. The total collapse in paper wealth across equities and real estate, by widely cited estimates, is in the range of approximately $15 trillion. For reference, the total US GDP in 1990 is approximately $5.9 trillion. Japan erased, on paper, more than 2 years of US economic output in a single asset price correction. And the most consequential part of what followed was not the crash itself. It was what Japan chose to do next. When an asset bubble of this scale collapses, there is a specific sequence of events that a financial system has to work through. Banks are holding massive loan portfolios, backed by assets that have lost much of their value. Loans extended against collateral that is now worth a fraction of what it was at origination. In a standard financial resolution, banks recognize those losses, write down the non-performing loans. The weakest institutions are restructured or closed, and credit eventually flows again toward productive uses. This process is painful. It typically involves 2 to 5 years of severe economic pressure. It is also finite. Japan did not do this. Instead, with the active tolerance of Japanese financial regulators, Japan's banks adopted the approach that economists now call extend and pretend. Rather than recognizing losses on non-performing loans, banks rolled those loans forward. They continued extending credit to companies that would have been forced into insolvency if the losses had been recognized. These companies, kept operating by credit they were not earning the right to access, are now referred to in the economic literature as zombie companies. They consume capital, they hold market positions, they employ workers, they generate no meaningful new economic value, and they cannot be displaced by more efficient competitors because they cannot be allowed to fail. Here is what an economy looks like when this persists for a decade. Capital that should flow toward new businesses, new sectors, and new technologies stays locked inside non-productive incumbents. New market entrants, the kind of companies that drive economic renewal in every functional market economy, can't access credit on competitive terms because the banking system is already saturated with zombie debt. The banking system that should be allocating capital toward its most productive uses instead spends its capacity maintaining the failures of a previous era. Japan runs this system for approximately a decade before substantive bank restructuring begins in earnest. Meanwhile, a new framework for understanding what Japan was experiencing was being developed in real time. An economist named Richard Koo, working at Nomura Research Institute in Tokyo, Japan, is observing something that standard economic theory cannot account for. Interest rates in Japan are falling. By conventional economic logic, falling rates stimulate borrowing. Borrowing stimulates spending. Spending stimulates growth. It is not happening. Koo's observation: when an asset bubble collapses and corporations and households are simultaneously left holding debts worth more than the assets those debts will use to purchase, their behavior changes in a way the textbooks do not anticipate. They stop borrowing when rates fall. They use every available unit of cash flow to pay down existing debt. Not because they are irrational, because paying down a debt that exceeds the value of the asset it financed is the most rational available response when you are technically insolvent on paper. Koo calls this a balance sheet recession. The critical implication: in a balance sheet recession, cutting interest rates cannot stimulate the economy, because the binding constraint is not the cost of borrowing. It is the fundamental desire to take on any new borrowing at all. Nobody wants more debt when they're still working through old debt. By 1999, Japan's Bank of Japan takes its official policy rate to zero, the first time a major economy deploys zero interest rate policy in the modern era. Standard economic theory predicted this should be the most stimulating possible monetary condition. Japan demonstrated, empirically, that when balance sheets are the binding constraint, rate levels are no longer the relevant variable for restoring demand. And this is the part that most financial media coverage of Japan consistently underweights. Japan in the 1990s was not simply running a failed economy. Japan was documenting in real time a phenomenon: the limits of conventional monetary policy when debt overhang is the primary constraint, that the world's major central banks would not encounter at full scale until 2008 and beyond. Japan's lost decades are the most comprehensive field study available on what happens when monetary policy exhausts its conventional tools at national scale in a developed economy. The Japanese government's fiscal response to all of this spans approximately a decade. Between 1992 and 2000, Japan's government launches approximately 14 major fiscal stimulus packages. Infrastructure spending accelerates significantly. Roads, bridges, tunnels, and public works projects across Japan, including in rural regions with declining populations and limited economic need for the infrastructure being constructed. Some of this spending is productive. A meaningful portion is politically motivated and economically inefficient by any reasonable assessment. The aggregate fiscal result is not the sustained recovery that each package targets. And the direct consequence of a decade of stimulus without growth, Japan's debt-to-GDP ratio, approximately 60% in 1990, begins a long upward trajectory toward what eventually approaches 260%. Here's the data point that makes Japan's debt situation fundamentally unlike any of the sovereign debt crises that have ended in default. Japan's government debt is approximately 90% held by domestic institutions, Japan's own banks, pension funds, insurance companies, and the Bank of Japan itself. It is denominated in yen. Japan prints its own currency. Japan is, simultaneously, one of the world's largest net creditor nations. Its overseas assets exceed its overseas liabilities by more than $3 trillion. This is the precise reason Japan has not defaulted at 260% debt to GDP when other countries have defaulted at far lower levels. The structural features of the debt, who holds it, what currency it is in, are fundamentally different from Greece's, Argentina's, or post-World War I Germany's situations. I covered exactly why those three countries reached their breaking points and why the mechanics are incomparable to Japan in an earlier video on this channel if you want that full analysis. Now, the human reality of what the lost decades meant for the people living through them. Japan's corporate culture across the entire post-war miracle era had been built on a specific, deeply embedded social contract. If you committed your career to a company, your loyalty, your labor, your identity, the company committed back. Lifetime employment was not a legal requirement. It was a social norm so strong, it functioned as one. When the bubble burst and companies stopped growing, the contract held for existing employees. It was not extended to new graduates. U.S. workers who graduated from university between approximately 1993 and 2005, who entered the labor market at the worst possible moment in modern Japanese economic history, are referred to in Japan as the Shushoku Hyogaki generation, the Ice Age generation. An estimated 1.5 to 2 million people from this generation entered irregular, part-time, or temporary employment during those years, and for a significant share of them, that became a permanent condition rather than a temporary one. They are now in their late 40s and 50s. They carry lower lifetime earnings, lower household savings, and significantly lower rates of marriage and family formation than any other cohort in modern Japanese history. Japan's current demographic pressure, the aging population, the falling birth rate, is not entirely an attitudinal or cultural phenomenon. A measurable portion of it traces directly back to the economic conditions that one specific generation faced in their 20s. And here is what I want to acknowledge plainly, because most analysis of Japan's lost decades omits it. During 20 years of economic stagnation, deflation, rising debt, and failed stimulus, Japan's unemployment rate peaked at approximately 5.7% in 2002. Crime rates remained among the lowest of any major economy in the world throughout the entire crisis. Universal health care persisted. Social infrastructure held. Japan's lost decades represent an economic failure that preserved human stability in ways that most countries facing equivalent economic pressure have not managed. The economy failed to grow. The society did not fracture. Those are two different outcomes, and conflating them produces an incomplete analysis of what Japan's experience actually demonstrates. By 2012, Japan has experienced flat or mildly negative consumer price inflation for approximately 15 consecutive years. The Nikkei 225 is trading approximately 70% below its December 1989 high. The Ice Age generation is now in their 30s and 40s, carrying the full economic weight of having entered the labor market at the worst possible moment. Japan's population is aging faster than any other major economy, and the birth rate continues to decline. In December 2012, Japan's Prime Minister Shinzo Abe returns to office with a specific, publicly stated mandate: end deflation. What Abe launches is the most ambitious and comprehensive attempt to restart a stagnant developed economy that any major nation has attempted in the modern era. It is called Abenomics, and it rests on three policy pillars, referred to publicly as 3 arrows. The first arrow, aggressive monetary easing. Japan's central bank, the Bank of Japan, under a new governor named Haruhiko Kuroda, announces it will purchase Japanese government bonds at a scale previously unattempted by any major central bank. The overall goal was to inject liquidity into the financial system at an extraordinary rate, weaken the yen, raise inflation expectations that have been anchored at zero for 15 years, and break the deflationary psychology that has become embedded across Japan's economy. The Bank of Japan goes further than conventional central banks had gone before it. It begins directly purchasing equity ETFs, exchange-traded funds holding positions in Japan's listed companies. The Bank of Japan becomes, through this program, one of the largest effective shareholders in Japan's public corporate sector. A central bank, an institution whose traditional function is managing monetary conditions, not owning equity, is now a major direct participant in Japan's stock market. There is no modern precedent for this among major central banks. In 2016, the Bank of Japan introduces what it calls yield curve control. Under yield curve control, the Bank of Japan targets the yield on Japan's 10-year government bond at approximately 0% and commits to purchasing unlimited quantities of those bonds to hold the yield there. In practice, Japan's government can borrow for 10 years at essentially zero cost for as long as the Bank of Japan maintains this commitment. The second arrow, targeted fiscal spending. Rather than the broadly distributed, politically motivated infrastructure spending of the 1990s, this iteration of fiscal stimulus targets specific high-return areas: childcare expansion, elder care infrastructure, energy modernization. The third arrow, structural reform. Policies to increase female workforce participation, expanding childcare access, creating incentives for companies to promote women to management roles, alongside corporate governance reform requiring independent directors at publicly listed companies. The third arrow is widely assessed as the least effectively executed of the three. One area within it, however, produced measurable results. Japan's listed companies significantly improved their return on equity between 2013 and 2019 under sustained governance pressure to prioritize shareholder returns, a real and verifiable improvement in corporate capital efficiency. Now, what Abenomics actually delivered, and what it did not. The Nikkei 225 more than doubles between December 2012 and the end of 2013, a real significant recovery in equity valuations. Japan's unemployment rate falls from approximately 4.3% in 2012 to approximately 2.4% by 2018, the lowest level in decades. Japan's female labor force participation rate increases from approximately 63% in 2012 to approximately 71% by 2019, a verified, meaningful improvement. Corporate profitability across Japan's listed sector improves meaningfully during the Abenomics period. And the intellectual honesty this analysis requires means covering what Abenomics did not deliver with equal precision. The 2% inflation target. Japan does not sustainably reach 2% consumer price inflation for approximately 7 consecutive years under Abenomics. Wage growth. Despite Japan's unemployment falling to multi-decade lows, levels that in most economies would generate significant upward wage pressure, wages in Japan grow only modestly. This is a real and important observation. Japan's workforce, shaped by decades of prioritizing job security over compensation increases, does not respond to tight labor market conditions the way standard economic models predict. The cultural and institutional factors conditioning that behavior are not easily changed by monetary or fiscal policy. In October 2019, Japan's Prime Minister Abe raises the national consumption tax from 8% to 10% to begin addressing the fiscal deficit. Consumer spending contracts sharply in Q4 2019, immediately before COVID-19 arrives and compounds the pressure. And Japan's debt-to-GDP ratio continues rising throughout the Abenomics era. The policy doesn't shrink the debt burden, it changes its composition. More of it is now held by the Bank of Japan itself, but the total does not decrease. In August 2020, something happens that deserves specific attention. Warren Buffett, the founder and chairman of Berkshire Hathaway, and among the most studied long-term value investors in the history of modern finance, discloses that Berkshire Hathaway has acquired approximately 5% stakes in each of Japan's 5 largest trading companies: Itochu, Marubeni, Mitsubishi Corporation, Mitsui, and Sumitomo. These are what Japan calls Sogo Shosha, diversified trading companies that operate across dozens of industries and commodity markets globally. Buffett's stated rationale: these companies were trading at valuations far below what their underlying businesses were worth, with strong multi-decade dividend histories and diversified global commodity exposure that Buffett considered underpriced. By 2023, Berkshire Hathaway has increased its stakes in each of these companies to approximately 8.5%. Here is the precise analytical observation this investment makes. Among the most studied value investors in modern financial history looked at a market that mainstream commentary had labeled effectively uninvestable for 30 years and found that the underlying businesses had been generating genuine compounding value the entire time. The market's failure to reflect that value for 3 decades was itself the investment opportunity. That is not optimism. It is a verified record. Now, where Japan's story stands as of mid-2026. COVID-era supply chain disruptions in 2020 and 2021, combined with the global energy price shock that followed Russia's invasion of Ukraine beginning in February 2022, deliver something Japan has not seen in approximately 30 years. Sustained inflation above 2%. Japan's core consumer price inflation moves above 2% and stays there. Japan's central bank initially assesses it as likely temporary. It is not temporary. Starting in March 2024, the Bank of Japan begins raising interest rates for the first time in approximately 17 years. Over the following approximately 2 years, the Bank of Japan raises its policy rate in steps to 0.25%, to 0.50%, to 0.75%, and then to 1.0% on June 16, 2026. 1.0% is the highest official policy rate in Japan since approximately 1995. That is a 31-year high, reached incrementally across approximately 2 years, after roughly 25 years of near zero or negative rates. And here is why that specific number, 1%, matters more than the figure itself suggests. For approximately 25 years, investors across the world have been borrowing money in Japanese yen at near zero cost, because the cost of borrowing yen was effectively zero. They took that borrowed yen and immediately deployed it into higher-yielding assets in other countries, U.S. Treasury bonds yielding 4 to 5%, government bonds in other markets, equities, cryptocurrency. The arithmetic: borrow at zero, earn 4 to 5% elsewhere. The difference, the carry, is profit, as long as the yen does not strengthen significantly enough to erase it. This is the yen carry trade, and the estimated scale of outstanding positions in this trade, accumulated across approximately 25 years, is several trillion US dollars globally. When Japan's central bank raises rates, the cost of borrowing in yen rises. When the yen strengthens, which tends to happen as Japan raises rates, carry trade positions lose value on the currency exchange leg. When a sufficient number of investors decide to close their carry positions to repay their yen borrowings before the yen appreciates further, they must sell their held assets and buy yen back, simultaneously, across all asset classes. This is precisely what happened in August 2024, when the Bank of Japan raised its rate from approximately 0.1% to approximately 0.25%. Japan's Nikkei 225 falls approximately 12% in 2 trading days, one of its largest 2-day declines in its recorded history. Global equity markets fall simultaneously across multiple major exchanges. Bitcoin's price falls approximately 20% in approximately 48 hours. All of this happened because Japan's central bank raised its rate by 15 basis points. A 15 basis point policy rate change in Japan sent simultaneous shockwaves through equities, bonds, and cryptocurrency markets worldwide within 48 hours. Nobody talks about this specific mechanism clearly enough. The currency and carry trade mechanics behind that connect directly to an earlier video I made on how currency dynamics affect wealth that is worth watching alongside this one. Japan's interest rate decisions are not a domestic monetary policy story. They are a global market architecture story. As of June 2026, the Bank of Japan's policy rate is at 1.0%. The interest rate gap between Japan and the United States remains approximately 250 to 350 basis points. The carry trade incentive has not been eliminated. It has been reduced. The Bank of Japan also faces a specific arithmetic constraint, and it is worth stating this precisely, without prediction. Japan's government holds approximately 1,100 trillion yen in outstanding debt. Every full percentage point increase in the average interest rate on that debt adds approximately 11 trillion yen to Japan's annual debt service bill, roughly equivalent to $70 billion at mid-2026 exchange rates. This is not a prediction that Japan will default. Japan's structural features, approximately 90% domestically held debt, yen denomination, current account surplus, net creditor status, make the conventional default pathway significantly more constrained than it was for any country that has actually defaulted under comparable gross debt figures. It is a statement of the arithmetic. The arithmetic creates a real constraint on how far and how fast Japan can raise rates, regardless of what inflation or growth conditions might otherwise warrant. And here is the full picture that any honest analysis of Japan's current situation requires. Japan holds one of the highest robot-to-worker ratio of any major economy. It has been accelerating investment in AI and automation as a documented policy response to demographic decline. Whether AI-driven productivity growth can meaningfully offset the economic drag of an aging, shrinking workforce over the next 20 to 30 years is a genuinely uncertain question, and even the economists who study this most closely disagree on the answer. It is a real possibility, not a certainty. Japan's foreign exchange reserves are among the largest in the world, a financial buffer that very few countries in comparable debt situations possess. Japan's current account remains in surplus. Japan continues to earn more from its international economic relationships than it spends on them. Japan's social infrastructure, universal healthcare, among the world's lowest crime rates, functional public services, remains intact despite 30 years of fiscal pressure. The complete picture of Japan's current situation is significant arithmetic constraints, a real fiscal ceiling on how fast normalization can proceed, and specific structural advantages that make predictions highly uncertain by the available evidence. What is not uncertain is this: Japan's normalization attempt, moving policy rates from near zero towards something higher while carrying approximately 260% debt to GDP, has no verified historical precedent at this scale. We are watching a live experiment, with no established baseline for what the outcome should look like. Now, the reason this 30-year story matters to every person watching this, regardless of where they live. What Japan experienced is not unique to Japan. What is unique to Japan is that Japan experienced it first, and at the most extreme scale of any major developed economy. The 6 variables that defined Japan's economic trajectory are now present, at different stages and different intensities, across most of the world's major economies. First, debt to GDP trajectory. Japan moved from approximately 60% debt to GDP in 1990 toward approximately 260% over 30 years. The United States has crossed approximately 125% and continues rising. Several European economies carry ratios above 100%. Some published estimates of China's combined public and private debt approach 300% of GDP. Second, demographic aging. Japan's population began aging faster than any other major economy. Japan's median age is approximately 49, the highest of any large country. South Korea, Italy, Germany, and Spain are following closely. China's demographic dividend, the surplus of working-age people relative to dependents that powered its growth, has reversed. The United States, United Kingdom, and Australia are aging more slowly, but in the same direction. Third, near-zero rate legacy. Japan introduced zero interest rate policy in 1999. The U.S. Federal Reserve held near-zero rates from approximately 2008 to 2015, and again from approximately 2020 to 2022. The European Central Bank ran negative rates. The UK maintained historically low rates for over a decade. The accumulated effect of this extended period, elevated asset valuations, increased leverage, The creation of significant carry trade positions across currencies is now present across multiple economies simultaneously. Fourth, the normalization challenge. Japan is attempting to raise rates from near zero while carrying approximately 260% debt to GDP. The United States, the European Union, and the United Kingdom have attempted the same since 2022 and face verified constraints from high debt levels on how far and how fast rates can sustainably rise. Japan's current monetary position is roughly 15 to 20 years ahead of where the US sits on this specific dimension. Fifth, asset price dynamics. Japan's 1985 to 1989 bubble was driven by self-reinforcing debt finance asset purchases, amplified through interconnected corporate balance sheets. Economists studying multiple markets in the 2020 to 2024 period have recorded elevated leverage, compressed yield spreads, and speculative positioning at levels that historically have preceded significant corrections across multiple asset classes and geographies. Sixth, recovery pathway. What eventually moved Japan's corporate sector back toward productivity was a combination of corporate governance reform, currency adjustment, export recovery, and eventually the inflation that Abenomics could not manufacture, but COVID and the Ukraine war delivered. Those same variables, governance pressure, currency dynamics, the post-zero rate inflationary cycle, now exist in the global environment. So here is the diagnostic question that Japan's experience gives any serious investor or student of macroeconomics. For any major economy you're thinking about, your own country included, where does it sit on each of these 6 variables? Not to predict what will happen, to understand what structural forces are already in motion and what direction they are pointing. Japan reached approximately 260% debt to GDP and did not default, but it also did not escape the arithmetic. Every percentage point of incremental interest rate increase adds approximately 11 trillion yen to Japan's annual debt service cost. Every year of below replacement birth rates narrows the working age population that will be servicing that debt in the future. These are not crisis predictions. They are compounding arithmetic constraints that shape what is possible for Japan's government, for Japan's central bank, and for the investors and economies globally that are interconnected with Japan's financial system. And I want to be very precise about what this framework does and does not mean. It does not mean other countries will follow Japan's exact path. Economic systems are complex. Policy responses have evolved significantly since Japan's experience. Each country's structural features, who holds their debt, what currency it is denominated in, what their current account position is, what their domestic saving rate is, create fundamentally different conditions, even when the broad aggregate variables look similar. What Japan's experience provides is the most comprehensively observed map of what this terrain can look like, not a prediction of what it will look like. Anyone who tells you otherwise, with certainty in either direction, is not working from the evidence. Here is where we are. Japan built something genuinely extraordinary, one of the fastest and most sustained industrial expansions in modern history, from near complete destruction in 1945 to the world's second largest economy by 1968. A specific chain of events, beginning with the Plaza Accord in 1985, running through emergency rate cuts, self-reinforcing asset price inflation across real estate and equities, and then a sudden monetary reversal, produced the largest asset price collapse in recorded economic history. Japan's response, maintaining non-performing loans through the extend and pretend approach rather than cleaning up the banking system, combined with fiscal stimulus that accumulated significant debt without producing sustained growth, created what Richard Koo documented as the world's first full-scale balance sheet recession at national scale. Japan eventually found a partial path forward through corporate governance reform, the Abenomics experiment, currency dynamics, and in a development that required a global pandemic to deliver, the inflation that 30 years of policy had been unable to generate. And now, in 2026, Japan is attempting something with no verified historical precedent, normalizing monetary policy from near zero while carrying approximately 260% debt to GDP in an economy that is simultaneously aging, investing heavily in automation, and serving as the collateral base for several trillion dollars in global carry trade positions whose unwinding affects every major asset market on Earth. 3 things you now understand that most people around you cannot explain clearly. First, how an asset bubble forms, inflates, and collapses, not in theory, but through a specific, verified chain of administrative, monetary, and behavioral decisions that played out in Japan between 1985 and 1990. Second, what approximately 25 years of near-zero interest rates actually do to an economy and the global financial system, including creating a multi-trillion-dollar mechanism, the yen carry trade, that connects Japan's domestic monetary policy to asset prices in every market on Earth simultaneously. Third, why Japan's current normalization attempt is the most consequential live monetary policy experiment running right now, and why its outcome over the next 5 to 10 years will be studied by every central bank, every finance ministry, and every serious investor in the world. Japan's story is not finished. It is in its most consequential chapter. The 30 years behind us are the context that makes what comes next comprehensible. What happens as Japan continues raising rates, as the carry trade gradually unwinds, as demographic pressure intensifies, as AI and automation either compensate or fall short of what Japan's fiscal math requires? That is the chapter the rest of the world will be taking notes on. And now you have the full framework to read those notes when they arrive. If this gave you a framework for understanding how economies actually function at a structural level, the books I have included in the description below are the ones I consider most directly relevant to everything we covered today. They cover crisis pattern recognition, reading central bank signals, and the psychological discipline required to invest through exactly the kind of extended, compounding uncertainty that Japan's 30-year story represents. And since you stayed through the full video, the videos appearing on your screen now go deeper on some of the specific forces we touched on today, including the global monetary dynamics and debt mechanics that connect directly to everything Japan's story reveals. If this is the level of analysis you want more of, subscribe, and I will see you in the next one. Thanks for watching.